This is Fintech Insider News. This week, Jamie Dimon's warning to the fintech world, Barclays is back on the high street as it opens small branches, and NatWest and Sainsbury's launch an 18 million member embedded play. We'll be tackling all of this and more on today's news show. Your financial product moves money across multiple systems: payment processors, banks, digital assets, custodians. Each holds its own records, its own version of the truth. But you don't. Without a single source of truth, tracking funds, reconciling mismatched timelines, or producing a clean audit trail becomes a manual, error-prone process stitched together with spreadsheets and logs. Formance is a programmable core ledger that unifies every system money touches. Build a complete chart of accounts, connect your financial infrastructure, and instantly trace funds across the payment lifecycle with a full audit trail and no manual reconciliation. Formance, the unified ledger for the hybrid economy. Find out more at formance.com.
As a chef, I know flavor doesn't begin in the kitchen. It begins on the land. And Westhome's nature-led Australian Wagyu is a story written in the landscape of Northern Australia. Cooking is storytelling, and Westhome Wagyu carries a story of Northern Australia itself. Raw, powerful, and deeply authentic. It's a testament to the passion and care raised in the rhythm of Northern Australia. I'm Chef Maylin from 88 Club in Los Angeles, and I invite you to visit westhome.com/Maylin to learn more. And taste a story only Westhome nature-led Australian Wagyu can tell. That's westhome.com/MEILIN.
Hello and welcome to episode 1054 of Fintech Insider News, brought to you by 11FS, the 5-time consultancy of the year that works with financial providers big and small to build the next generation of financial services. I'm Laura Watkins, Director of Media and Marketing at 11FS, and to help me unpack the biggest and most interesting stories from fintech and financial services from the past week, I'm joined by a brilliant panel of guests. First up, we have a welcome return to the show for Oliver Smith, Head of Content at Money 2020 Europe. Thank you so much for joining us, Ollie. That was very formal of me to call you Oliver there, sorry. Could you please reintroduce yourself to the listeners and tell us a little bit more about what's coming up and what to expect at Money 2020 Europe? We know when this show goes out, you will have a kind of exciting announcement about this year's event. Can you tease that for us now?
Yeah. Great to be here. I'm head of content for Money 2020 Europe. That means I'm responsible for the whole agenda over the whole 3 days, 450 speakers, a huge number of sessions going on. As this show lands, we'll be announcing the full agenda is now live on the website. So you can go to money2020.com. You can browse the full agenda over the whole 3 days. You can see all of our fantastic speakers. And just to call out a few of them, we're absolutely delighted to have the CEO of BBVA joining us this year, Onur Genç. So it's great to have him joining us. We've got the CEO of ABN AMRO. We've got the President of Europe for MasterCard. We've got the co-CEO of Kraken joining us as well. Lots of excitement around Kraken at the moment. I would just really encourage everyone to have a look and see who we've got coming this year.
Fantastic. Thank you so much for that. And also, a lesser-known podcast called Fintech Insider, right?
Absolutely.
So we will see you there as well. Thanks so much for that, Ollie. Next up, we have a warm welcome back to the podcast for Sarah Kocianski, fintech consultant and analyst. Great to see you, Sarah. What have you been up to since you were last with us?
Well, first of all, Ollie, I'm offended you missed my name off that list. Honestly, Money 2020 is the highlight of my year, so very much looking forward to that and prepping for that is what I've been up to recently. I can't remember when I was last on, but I've been working with some exciting new clients. I've been doing a range of things. I'm really getting back to my roots, been doing some competitor analysis, been helping people understand the open banking market because that's coming back as a really, really interesting space, and been helping people develop their content because, everybody seems to think that Claude can do it for them and it just can't. I'm sure it will be able to relatively soon, but I've been working with a lot of people, helping them make sure that their content is still insightful, accurate and human-centered.
Absolutely. Definitely a priority. I think, given what I do, I would hope that, the human is still very much at the forefront of that and it isn't all just AI going forward. So, yeah, important stuff. And next up, we have a debut on the podcast for Chouiekh, business reporter at The Logic. Welcome to the podcast. Please, can you introduce yourself and The Logic, actually, to our listeners? Because I'm not sure we've had anyone on from there before.
That's true. Thanks, Laura. It's nice to meet you. It's nice to meet you, Ollie and Sarah. My name is Chaimae. I'm a business journalist covering Canadian banks and Canadian capital markets, Canadian money flows for The Logic, and I'm currently in Toronto. That is surprisingly sunny. We're not known to be sunny. Thanks for having me at The Logic. We're Canada's tech and business newsroom. We're backed by the Financial Times. We're syndicated on the Bloomberg Terminal. You can also find us on Apple News, and we cover anything and everything related to Canada's national affairs, Canada's businesses, and how Canada relates to the world. So very excited to be here.
Fantastic. Well, thank you so much for joining us. And I think from what we've seen of your work, you have a lot of thoughts on our first story. So I'm going to jump straight into that one today, which is looking at Jamie Dimon's annual letter to shareholders. So the CEO of JP Morgan, Jamie Dimon, has released his 2026 annual letter. It's a 40-plus page State of the Union for global finance, where he reflects on his 20-year legacy at the helm while sounding the alarm on sticky inflation, quote, the dangers of the $1.8 trillion private credit market and why AI is the most consequential force he has seen in his entire career. As Ron Shevlin recently put it, this is effectively the most important fintech memo of the year. And today, the reason we're talking about this, we're going to break down the most influential bits. So, Chaimae, you covered this letter on The Logic. What do you think makes this so important? Is, how much of what he has to say is sort of taken as a signal by the wider market? Should we be paying attention?
I think this letter is the most followed letter in Wall Street and the world most generally. And what makes this letter particularly important to fintechs is how Dimon kind of made this distinction between, I guess, the traditional, established, non-traditional players, I guess, like Block, Revolut, and Stripe. But more importantly, I guess he described a new wave of competition, the blockchain-based wave of competition that includes, of course, stablecoins, smart contracts as kind of its separate threats and its separate beasts. He kind of said that the first fintech wave of disruption was just like one phase, and the tokenization and blockchain is kind of infrastructure is the next phase. I think it kind of legitimizes this aspect that fintechs have been kind of championing for years. If a traditional institution like JP Morgan is now seeing this as a competition, Dimon also said that JP Morgan needs to roll out its blockchain technology a little bit more and a little bit faster. Obviously, he tied all of this to AI and how it's going to be a technology that moves fastest than previous technology shifts. So I think it was a good wake-up call that touched upon all aspects of banking and how it's going to change in the future, whether it's deposits, asset management, you name it.
Fantastic. And Sarah, bringing you in, given what you were talking about AI in your intro, Dimon has compared the impact of AI to that of electricity or the steam engine, and saying that JP Morgan will spend nearly $20 billion on AI in the next year. And he specifically warned about agentic commerce and sort of bots making decisions for humans. What's your take on that?
Yeah, I mean, it was funny enough. Where I've been looking at this recently is actually from the perspective of the job market, who gets upskilled in AI, how they get upskilled. I'm using the upskill is just a generalist term here, because I think it's been really interesting. And there was a piece insisted about this week about the people who are almost getting ahead of that curve, understanding what it can be used for, how important it can be, are the people with access to it. And those are the people with resources. And a lot of those people have been scooped up by people like JPM, but they're in engineering departments, they're developers. They are, generally speaking, affluent young men. Now, what that means is that those people are getting ahead of the curve when it comes to, what AI is going to look like and what AI roles are going to look like. And the reason that's relevant here from my perspective is that Dimon said that AI is going to influence every aspect of the bank and what it does. So that means every job, every role within JPM is going to change. And it's really interesting to me who is going to get those jobs and who's going to be ready for those jobs when they come in and who's going to fit those new, for want of a better term, job descriptions. And that is relevant if you tie it back to what Dimon said about the Industrial Revolution, right? Who kept their jobs, who lost their jobs, who progressed and who made forward. Laura's smiling at me, history degree over here. I will always tie it back if I can. But I think his point is relevant. I think it's valid. I think we should listen to it. I think we should be looking at what impact AI and its role on the workforce is having from a broader societal impact. Take it back down a bit more narrowly, if you like, to talk about what JPM is doing here, particularly with relevance to the agentic space. He warned of the threat to data and security, because as agents start interacting, as people start giving agents access to more and more of their data to help them do more and more things, who is in charge of that data security? And one of the things he mentioned, and I know Ron Shevlin mentioned in his analysis of this letter as well, is there a way for banks to combat the threat of agents and external AI by positioning themselves as the guardians of that data? That's the term Ron Shevlin used. I'm not sure it's the best one, particularly as somebody who's been looking at open banking. But I think the important thing to say is that they're thinking about it. Jamie Dimon is not wrong about it. That's going to impact every aspect of the bank. And everybody else needs to be looking at that too, what it means for their workforce and what it means for their position within the financial services value chain. That's probably more than you wanted. I've been thinking about it all week. Sorry.
No, I appreciate it. Yeah, if they're going to put $20 billion a year behind it, they obviously are considering it at a holistic level, not just the kind of the one point mentioned there, which was the agentic commerce. It is going to change so much. And Ollie, bringing you into it, what's your kind of take on that? He's also mentioned the private credit market as a sort of warning space. Suggesting, quote, there's cockroaches in the cellar when the credit cycle turns. What's your thoughts on that?
Yeah, it's super interesting. I mean, when I was a journalist at AltFi, we spent a lot of time writing about the alternative finance market and what was going on in that space. Certainly since the financial crisis, I think we've done a great job at de-risking banks and really pushing them away from the riskier elements of lending. And in that place, we've had this private credit industry, which has really blossomed and has been super critical for supporting SMEs and supporting, businesses of all shapes and sizes. I think Dimon's actual sort of line at the end there, he said that private credit probably does not present systemic risk. So he sort of hedged it there. And I know they've repeated that phrase several times. I think it's interesting. Clearly there's questions to be answered around this space. I think it was the Financial Services Regulation Committee in the UK in Parliament who published a report about private credit a couple of months ago, and the title of the report was literally "Unknown Unknowns" because so little is sort of known about this space. Yet clearly, it is super important to key parts of the economy. I'm just glad more attention is being kind of shone on it at the moment, because I think it probably does need a bit of focus. I think it also, to tie it back to the previous point about AI, I mean, one of the biggest concerns is that these private credit companies, for one, there is just as a broad term for them, a lot of the companies they've invested in are software companies. And we've all seen the SaaS apocalypse. I'm not quite sure how you say that. Which means a lot of these private companies, private credit companies, are suddenly losing vast amounts of money. All the value of their investments is suddenly plummeting, and that's created something of a kind of widespread panic. So I think the two kind of link together, which potentially is where Dimon's coming from as well. Yeah, and especially because the sort of values on this credit isn't widely known. It's not in market. It's sort of privately decided. We don't have that kind of real time understanding of what's going on, and I think that's where the concern comes from, that there could be this big problem which is being kind of hidden until it suddenly comes out. But yeah, super interesting.
It's interesting to know that the UK has written about it because private credit is kind of this topic that is also starting to make headlines here in Canada. The governor of the country's central bank has warned about the risks around it because, as you said, we know so little about private credit and the deals that are happening there and how it's especially going to behave under stress. I mean, it is true investors are trying to pull out their money fast for our neighbors south of the country, companies like BlackRock and Blue Owl. As you said, Sarah, AI is kind of the big kind of topic that is driving investors to be scared that companies are going to turn obsolete and fears of competition. As far as Canadian banks are concerned, they seem to be pretty confident about their exposures to private credit. They say it's pretty minimal. Again, there's nothing to see here. Is that true? Is that not true? Do they have all the reasons in the world to say that there's not an issue here? I guess we'll see. It is the unknown, as you said.
Is Chaimae and Dimon just a bit sore because they lost 170 million on one of these companies that went bust? One of the two big companies that went bust had big private credit behind them at the end of last year. They lost about, I think it's 170 million. So he could just be bitter.
Possibly.
Yeah, equally a possibility. Equally, covered in this is a take on kind of hope for rate cuts that hasn't necessarily materialized. He's warned that inflation is structurally sticky due to the green transition and also sort of geopolitical conflicts. Ollie, what's your take on that? Were people expecting more from him on that kind of rate slashing side of the fence?
I mean, I think the last couple of months have really changed the framing of things at the moment. I think, it's now widely expected that we won't be seeing the rate cuts that everyone was expecting. That means that this environment is going to persist for a bit longer. It means that the pressure on fintechs is going to stay high, especially those looking to do Series A, Series B funding rounds. That's going to continue to be challenging, which it has been for the last couple of years now, really. I think that will continue to really prioritize profitability and sort of sound fundamentals within the kind of fintech ecosystem, which I think has been positive in many places. But I think it's reduced the experimentation that I think, certainly I really enjoyed covering in the late 2010s when we had those like blue sky thinking where a lot of fintechs were just throwing ideas out there. Now it's a lot more about making sure that the businesses are sound, because if you want to keep raising money, you've got to be proving that. So I think that environment is gonna stay. I'm kind of optimistic because I think I've seen loads of great companies still come through, even in this more challenging environment. We've seen, both at Money and previous to that, I've seen loads of great startups coming through, and I'm really excited about that. It's just a shame because I think everyone would love the cheap money era to come back because it would unlock a lot of excitement, let's say.
Mm. And then, Chaimae, I want to come to you just as we kind of wrap this section. Sitting where you do in Canada, and obviously we're recording from the UK today, how sort of seriously is this taken internationally? Is everyone kind of following what he says in terms of acting on it? Is he sort of speaking for the ecosystem writ large, or is he mostly speaking from a US perspective? Do we expect a lot of people to sort of take him at his word and act accordingly?
I think definitely he speaks more broadly internationally. I'm sure people here in Bay Street, which is the Canadian equivalent of Wall Street, are listening to what he's saying and kind of paying attention to what he thinks, because right now, post 2008, he has some credibility and people listen to him, to the kind of God voice that he takes. He definitely takes the extra step. He doesn't talk like a CEO only focused on his company and on banking. He's definitely a statesman for the financial system. Now, do they act on it? That's pretty different for Canada because the financial system here is kind of built differently than the US. But it's true that sometimes US sentiment can kind of bleed on this side of the border and people can start to get a bit stressed. But yeah, I think definitely people are listening to him. Are they acting on it? I guess we'll see.
Absolutely, we will. But that is definitely something we will be keeping an eye on, as will everyone else, I imagine. So I'm going to take us on to our next story. which actually is back here in the UK. Barclays is back on the high street as it opens more branches. This is in Daily Business. Barclays UK CEO Vim Maru has announced a major strategic pivot. The bank intends to stop the mass closure of branches and actually start opening more. This includes reintroducing the local bank manager to differentiate Barclays from the chatbot loops, his words, this is a quote, of digital-only competitors. Since 2019, Barclays has closed nearly 80% of its network, leaving just 206 branches. But Mario argues that great digital and great human touch is the actual future of banking. This isn't specific just to Barclays. Speaking of Jamie Dimon, Chase is opening 160 new branches across 30 US states this year. Nationwide is also doing something similar in the UK. There does seem to be a little bit of a push in this direction. Sarah, what's your take on this? Like, from 80% reduction to starting to put banks back on the high street. Why the U-turn? What are they solving for?
Well, as I was recently quoted in a raconteur article, I am a professional cynic. And this just smacks likely of politics to me. Certainly if you listen to some of the political refrain that you have in the UK at the moment, which, like a lot of Europe and the wider world, is swinging further to the right than perhaps some of us on this podcast would prefer. And that means extolling sort of what we might call like old-fashioned values and harking back to a time when, everything was better. I don't know this CEO. This is the first interview he's given since he was appointed in 2024, or first kind of big newspaper interview. So I don't know if it's unfair of me to tar him with that brush. To take a more kind of broader macroeconomic perspective on this, what we know is that when times get tough, which they are, and the UK and again for much of the rest of the world at the moment with the cost of living, people do two things. They regress to cash. This cash is much, much easier to budget on, to hold on to know how much you spent and how much you've got left. And they crave reassurance, often in the form of human connection. Now, those two reasons combined could be behind this move, because by taking away a lot of the branches in the UK, you took away a lot of the ATMs, you took away a lot of people's access to cash, and therefore you took away a lot of businesses' ability to deposit cash. So this could be kind of a reflection on the sort of general social move back towards using cash as opposed to electronic payments. It could also be an attempt to kind of provide that reassurance that people crave when times are tough. I don't really follow the we need bank managers back. I don't really understand the kind of having that person or that one person you're going to go and speak to again, because when you look at a lot of what's done in branches, it isn't actually mortgage applications, taking out life insurance. A lot of it is older people with who find it more difficult to use online services, doing what we would call basic services. So checking their account balance, taking money out, getting the reassurance that they're not being scammed. So actually, you don't need this kind of like figurehead person everybody respects, and the local bank manager. So that's my take on it. There is one other thing I'd like to mention, if I may, which is a report that came out this week called Hidden Heroes, Understanding the UK's 11 Million Financial Helpers, by a lady called Faith Reynolds, who we had on the podcast a while ago. And what that looks into is the 11 million people who are helping other people access banking services because they're unable to do it on their own. And again, if you look into the data in that report, it's a brilliant report, go and find it, have a read. It backs up what I've just said, because when people go and say, I need help with my banking, for whatever reason, they're unable to use digital services scare them, they confuse them, they're asking for people to check their bank account. They're asking for people to reassure them. But when they get those in-person meetings, they still need help, because the people they're speaking to in the branches, they don't understand. What they're saying to the people who need the help doesn't make any sense. And then the third point that's made is that the help that's provided in a significant number of cases is driving somebody to a cash point so that they can deposit or withdraw money, or taking them to a branch. So I think I completely agree with those points, and I think that ties into my point about the broader sentiment of this kind of return to cash and also the desire for reassurance. I don't think we need people in there rubber stamping bank loans. I just don't think that's what's going to happen, and I don't think that's actually what people want.
No, it's probably more about you need the bricks and mortar to get things done, but you're not actually that bothered about the individual who does it for you. It's not about relationship building, it's about getting things done. But I guess to your point around not being able to like always understand what's being said, a lot of the time in-person activities also then push you back online. So like, can I, oh, did you know you can do this on our website, or go over there in that corner and use that screen or that iPad or whatever. Like it's not always adding the human to it. So that I think if that's what they're stating as their mission, they're going to have to, try and work hard to prove that. Ollie, bringing you in on this around that kind of, the quote was that innovative businesses love the human touch. How much do you agree or disagree with that quote, and how does that kind of speak to the digital first push that we've seen over the last 10 to 15 years?
Yeah, I mean, it goes without saying that there are some times in life where you do want to have that human interaction. The classic examples are like business loans or certain mortgage applications. There's that kind of face-to-face element where I think whether it's a bank branch or it's a human, I don't know what form it comes in, but certainly there's a desire for that moment. We've seen banks try to reinvent the bank branch several times now. Coffee shops, they've done like, pop-up things, all sorts of experiments. I guess I'm optimistic that they're talking about opening more high street branches. I think that's positive. I think there's financial services that need that physical touch point in certain places. At the same time, I didn't see any numbers about what that means, what that look like. More is a sort of a direction. It's not a destination. So I'd be curious
more
to
is
see
more
what
than
that.
one, right?
Yeah.
Like,
it could be the flagship coffee shop. That could be what he talks about.
I mean, it's good that he's putting a flag in the sand and saying direction of travel. We want to invest and figure this stuff out. The conversation around bank branches has rattled on for many years in the UK, and I think it's so interesting because we have on one hand, pure technologists who are so passionate about the future of digital finance and what that can unlock, but then there is just the reality of those 11 million people, Sarah, as you mentioned, who need more than that. They need more than just digital, and at the moment, those people, a lot of them will be giving friends and family access to their financial services in order to help them do stuff that they don't know how to do, probably in breach of the T's and C's of the banks that they bank with, but just because they need help, and they need the kind of help that doesn't currently exist. There's no way for me to let my partner access my bank to help me do stuff at the moment, and there really should be. So yeah, I think direction of travel is good. I'd love to see some numbers attached to it.
Absolutely. I mean, on that numbers point, we mentioned at the top that Chase has committed to opening 160 branches as part of their US expansion. So they have actually gone out with a number. Whether they achieve that is TBC, but that's what we've said. And they're specifically targeting low-income and rural areas. Chaimae, how do you kind of feel about that? Is that sort of what is needed? Because I think kind of to Ollie's point about direction of travel and lack of numbers is like, we don't need necessarily one on every corner in London. It's actually more where banking services have been taken away completely from these communities where there's no bank on the high street of any brand. And is that something that's sort of reflected in what you're seeing, and how valuable do you think this shift could be?
So in Canada, it's a very layered conversation. I actually pulled some data comparing Canada to the UK, Australia, Ireland, the Netherlands, and Sweden. And we're actually the country that had the least number of bank branch closing, just minus 9% between 2012 and 2022. And that's the latest data that we have. And I see here that the UK is minus 44%. So or like the Netherlands minus 45%, the US minus 16% in those 10 years. So it can show you here that Canadians really still want their bank branches, especially in rural areas and certain territories and provinces where a lot of Indigenous communities live. So far, Canadian banks have not expressed an interest in closing down branches. They still apparently see value to them. But what they do say is that while you're waiting in line to talk to a bank agent or a rep, you're automatically also being put on hold with an AI agent or using your app, and kind of streamlining that process in two different ways: the human touch if you want to use it, and the non-human AI touch if you also want to use it. I think Canada so far is still pretty conservative in, going full technology, full remote. People are, and that shows in the numbers. Is that going to change maybe in the big cities where public transportation is pretty available? But as you know, Canada is a very big country, a very remote country, and very cold. So for people to go from one place to another in certain territories and provinces, it can be quite difficult. So that's what I think was happening for Canada right now.
Fantastic. And Sarah, kind of to Chaimae's point about being sort of funneled when you're on hold, or speak to the AI agent, stay on hold, speak to a human, etc. Part of what Vin-Mary was talking about in this particular Barclays example is the frustration of being stuck in a chatbot. Does a physical branch solve for that, or should they just sort out their chatbots? Is he accidentally calling out his own products?
Yeah, I mean that links back a little bit to what I think I was probably inarticulately trying to express, is that what do people want the branch for, and is it just because they can't get anybody on the end of the phone? Because that's a human touch as well. Now, I can understand the difference between being directed to a chatbot, or the worst one in my head is did you know that you can do all these services on our website? Yes, I did. And if I have to listen to this on hold for 20 minutes when I get through, I'm not going to be very pleasant to speak to. But yeah, no, I think it really gets down to what banks need to do is work out what customers are struggling with and help them do it. And if the way to do that is to open new branches, because it absolutely is to do with depositing cash, or as Ollie says, more people want business loans, and that requires, a more personal face-to-face interaction, then yeah, go ahead, open new branches. But if what it is actually, I don't need to meet you in person, and actually this would be a lot easier if I could do it from my desk at home, if you would just pick up the phone, and if the person at the other end of the phone could help me. And I think that's really where we've seen some banks investing in AI, but where they really should be investing more is, how do you make those people at the end of the phone more helpful? How can they answer more complex questions? How can they be honest? How can you tie up your systems at the back end so you don't get passed from person to person and have to restate your details every single time? How can they make security checks less onerous but also more robust at the same time? So yeah, it all comes down to what do you need help with and what isn't working, and then what is the best solution for the maximum number of people, in my mind.
Definitely. And I think to the point that you made there around phone still being a human touch is so important, because you don't need a whole building for the human touch if you can get the phone element right first. If that is, look at your data, where are you getting footfall, so to speak, if that is phone calls? Can you just get people to the answers that they need via that service, rather than having to bring bricks and mortar back, because equally that is a huge cost undertaking for these banks as well. So,
and just to jump in, it's so interesting because when I think about retail and how omnichannel in retail has been the buzzword for however long now, but I think retail has this really clear understanding that consumers want to interact with retailers in different ways, and they need to make sure that the experience is as good as it can be in every format, whether that's on the phone, on the website, or click and collect being the kind of classic example where people want to have an interaction that bridges two of these kind of formats. Maybe you want to have a phone call and then physically go and do something. And I think banks, and again, this memo gives me optimism. Maybe he is thinking about this differently. Banks need to be thinking about that. Maybe I start off on the phone, but then I want to have a meeting and I want to book that and go and see someone and not have to restart the conversation, but actually to follow up in person. Again, I think banking in this branch format is just very behind from everything else we see on the high street.
Yeah, completely agree. Bringing back that sort of human connection all the way through the experience, bringing back good customer service that retail gets right. And, that is a criticism that's often leveled at banks in any form, whether it's chatbots, phone, in the branch, is that the service is sort of lacking. And, as David often says, this is financial services, but sometimes we forget the services part. On that note, we are out of time on this one, so I'm just going to take a quick pause. Back very shortly.
Over 40,000 businesses across Europe trust Pleo to manage their spending. Now, platforms like yours can offer Pleo's capabilities, cards, spend controls, and real-time visibility directly to your SMB customers under your brand and integrated with your product. Pleo Embedded allows platforms to unlock a new revenue stream quickly without building from scratch. Solve your customers' biggest admin headaches, become indispensable, and earn every time they spend. Visit embedded.pleo.io to find out more.
Before we get back to the news, I just wanted to tell you about our latest Insight show. We're taking a look at the shift towards agentic payments, asking what happens to trust and liability when we stop making payments and start delegating decisions to machines. That's available in the feed today, so be sure to give it a listen after you finish this show. Back to the news. And our next story is that NatWest and Sainsbury's have announced a new partnership. So following NatWest's acquisition of Sainsbury's Bank's core business in 2025, the two giants have announced a long-term strategic partnership. NatWest will now power Sainsbury's financial products, including a new Nectar credit card, savings and loans, integrated directly into the Sainsbury's digital experience. And this is NatWest's third major embedded finance play, following similar deals with the AA and Saga. So Sarah, coming to you first. For years, sort of retailers, sort of supermarkets, for want of a better word, like Tesco's and Sainsbury's tried to be banks. Since recent times, they've sort of sold out and are now being run at the back end by incumbents such as NatWest. Is the sort of era of the supermarket bank over? What does that actually mean in terms of being powered by NatWest here?
I think it's interesting on this particular example that it's jointly branded, because we've seen sort of other supermarkets' books be bought by incumbent banks, the Tesco RBS partnership. Yeah, for a long time, you didn't know that RBS was what powered Tesco, for example. So I think it's interesting that it's a joint brand, and I think it's interesting that they've gone out there with two sort of separate sets of products, if you like. So you've got what you call a very classic product, which is a Nectar NatWest credit card. I'm not saying that at speed, which you will get a credit card and it will say, Nectar and NatWest on it, and you will then use that credit card for your daily spending and you will get Nectar points off the back of it. And that's a model that I think most people can get their head around. I think what's interesting is the sort of, if you like, secondary product, which is it's NatWest Boxed, which is the embedded banking product, which is the idea that they're going to be offering loans and savings accounts through Sainsbury's digital channels. I'm not quite sure what they mean by digital channels. I don't know if that's going to be in the app, or because if you go on the Sainsbury's website, which I did a quick look earlier, it just says at the top very clearly, all financial products are now, run by NatWest. Your account will be, changed over. So I think in terms of kind of the history of retailers' banks or supermarket banks, I don't think the idea of people saying I'm banking with Sainsbury's is going to go away, because the Sainsbury's brand hasn't gone away. I think for those of us who understand the back end, perhaps it's becoming a little bit more nuanced. But I don't think for the average person on the street, they're going to go out there and say, I bank with NatWest now. They're still going to go that Sainsbury's is my bank. This one's just a bit more complicated as well, because Sainsbury's is the supermarket, Nectar is the loyalty brand, and NatWest is the bank. So you've actually got three brands at play here, which is going to be another thing to see how they handle whose logo and which brand is most dominant on all the financial services products, I think.
Yeah, it is interesting. They have really hammed up the sort of Nectar partnership, so the sort of loyalty rewards points system for international listeners who may be less familiar. In the UK, Nectar has over 18 million members, which is a decent wedge of the UK population, and that's sort of can be used as a currency to pay for shopping, etc. Particularly at the moment, sort of cost of living, as we talked about. So, Ollie, what's your take on this? Is this more of like a data play by NatWest in terms of that visibility on the Nectar side, actually maybe giving you more interesting data than just the sort of Sainsbury's banking data, because it adds a further element that you wouldn't get just by buying the banking book alone?
Yeah, potentially. I mean, what fascinates me about this story, and this is a bit of a geeky thing, but I love following the evolution of the supermarkets in the UK, and as they over the years have tried in different ways to kind of like reach different aspects of our lives. You know, I can, again, for the international listeners, I can go to Tesco and I can get a Tesco mobile service. I can get a Tesco bank account. I can get Tesco travel insurance. I can get all of these kind of products. The Tesco near me even has a co-working space where I can pay a monthly membership and co-work in the Tesco. They have their own cafe. They have all of this stuff.
Mine just has a Domino's.
But it's amazing to me. I mean, I remember in actually it used to be even bigger because in the mid kind of 2010s, Tesco tried to launch its own tablet. I went to the launch in like 2013, 2014, and they were like, Tesco's going to be a tech company as well as a supermarket and all this sort of stuff. That died a death. But the ambition, I think, for these institutions to become much more than just a place you go to get food is fascinating. Now, some of these experiments have worked and some obviously haven't. I think with finance, we've really got to the point now where I think all of them accept that they shouldn't be trying to do this themselves. They should be relying on third parties, and actually they should be passing more and more of the onus onto those third parties because, as we've said previously on, financial services, it's a service. It requires a lot of elements that a supermarket won't necessarily be very good at, whether that is the customer service element, whether that is, the kind of financial advice, selling these financial products. An institution like NatWest is a lot more geared up for doing that. But yeah, I just count it as the latest kind of twist and turn in that journey of where supermarkets are in our lives.
Definitely. And where that sort of embedded finance side is going. Sorry.
No, I was just going to make a joke and say that like your grocery shopping experience sounds much more exciting than ours here in Canada.
Well, even the most recent television advert for Tesco, which is one of the really big ones here, actually focuses on this. They say, does anybody need anything from Tesco? And the first person says snacks, and somebody else says, I want a low price holiday, and somebody else says, and can you get me a mobile phone? And that's the whole I talk about TV ads whenever I come on here. But anyway, that's the whole premise. Like, that's how they're selling themselves. They're not selling themselves as like lower price groceries. They're selling themselves as like a one-stop shop, almost like a super app, if we want to compare them to the likes of Revolut, which Revolut will be very offended by. But
well, I kind of actually do want to build on that sort of train of thought. So like, the supermarket is becoming the super app, so to speak. And NatWest is sort of embedding themselves in that super app rather than building their own sort of maybe Revolut style. So Chaimae, from your perspective, is this something that's being replicated internationally? And does that also mean that the sort of actual banking part of banking is becoming more like invisible and sort of put inside somebody else's brand?
The only case that I can think of here in Canada is, so the Canadian financial system is pretty congested. It's a bit of an oligopoly. We have 6 big banks that kind of are holding 93 to 97% of the market share. So it's really hard for a challenger bank to kind of challenge these established institutions. And we do have one. It's called EQ Bank Financial. And they kind of struck a deal, for people who don't know, with PC Financial, who is part of Loblaw. Loblaw is a grocery chain company. It's one of 3 in Canada. And PC Financial is their financial services arm. And now this challenger bank, in order to, touch more people and get more market share, is kind of going towards getting data and getting clients from this very well-established grocery chain that is Loblaw. So that's the only case that we have here so far. And I think it's kind of the little players here in Canada is kind of their way to, stand up to the big guys and try to get as many customers as possible, because people here tend to be very loyal to their grocery chain, and especially Loblaw is known to be a little bit on the less pricier side. And with the cost of living and everything happening in the world, everything is being more and more expensive. And it was kind of a breakthrough collaboration or merger that happened in the country in December. So yeah, that's what's happening over here in the north.
Sarah, you were kind of nodding along there as Chaimae was talking. What's your kind of take on that, like kind of loyalty play in terms of sort of banking with your supermarket, for want of a better phrase, particularly when it comes to that sort of reward system, loyalty, kind of cost of living environment, etc.?
Yeah, I mean, I think it's I mean, I don't know if the stat is still accurate that you're more likely to get divorced than you are to change your bank account. That was the stat that was used for a long time here in the UK. I don't know if it works across the pond, but I think the sentiment probably translates. I would like to know how true that still is, given how much everyone is feeling the pinch and whether that's driving people to shop around more for whatever it is, including their bank. So I know, some of the banks that are trying to encourage switching will say, we'll give you 5% cash back for the first year if you come to us, or we'll give you, a lump sum of £200 if you come to us. And that could make a big difference to some people, particularly at the moment. And I do wonder if there's a draw to go back to the point you made earlier, whereas the points you're getting are nectar points, and you think, brilliant, well, I already shop in Sainsbury's, or Sainsbury's is part of a group, Argos, Habitat, whatever it is. I already use that brand. I already like that brand. So great, I'll switch my credit card to them, because then it compounds the points I already have. So I think there's definitely interesting to see if there's an aspect of there. I don't know how many credit card customers. I actually don't know if Sainsbury's already has a credit card. Sorry, I didn't do my research deeply there enough. So I don't know if this new credit card is an entirely new product, or if they're going to be encouraging people to switch from kind of an existing Sainsbury's credit card to a new credit card. The other thing, of course, is with a credit card, you can have as many as you want, sort of, within the realms of possibility. So do people then go down this rule of getting the NatWest one for certain shopping, and, I don't know, Halifax one for a different one, and an Amex for a third? How organised are people? I don't think that many people are that organised, or that many people have the headspace to remember which card to use for which account. So I think the loyalty play will be interesting. I think what's also going to be interesting is just how good is the deal you get with using the NatWest credit card. How many extra points do I get? What is the additional cash back? Is it better than what I've got at the moment? Because I think at the moment, a lot of consumers are looking into that in much more detail than they have done historically. And they're actually working out, well, if I use these points are more valuable to me, because the thing that's most important to me right now is feeding my family, and therefore it's the weekly shop, or money or fuel, or, all those sort of things that supermarket tend to offer.
Mm-hmm. People are paying much more attention to the small print and not just the headlines, and figuring out what works best for them, which I'm going to use as a segue into our next story, which is that Chime has launched Chime Prime Premium Banking. The story in the papers: Chime has launched Chime Prime, a premium membership tier with no monthly fee. Instead of a subscription, it is unlocked by members who receive at least $3,000 in monthly direct deposits. Benefits include 5% cashback on a chosen category, groceries, travel, etc., 3.75% APY on savings, a premium metal Onyx card, if that's your thing, and luxury travel perks like Priority Pass. Chime has also boosted its entry-level Chime Plus to 2% cashback. Charlie, kind of coming to you first. Are they sort of based on the kind of loyalty conversation we were just talking about in the previous story, and talking about how, people are maybe paying a little bit more attention to what they get for being loyal? What's your take on this one? This is kind of loyalty and perks based on how much you're sticking in your bank account, which equates to a degree to how much you get paid.
Yeah, I think this is really smart, and I'm surprised that maybe other people have done this before. But we've seen other challenger banks in the UK, at least, going down the paid subscription model to try and embed that loyalty. Whether it's Monzo or Revolut, they get you to try and sign up because you get all these benefits, and it means you become a sticky customer, and you're more likely to become a kind of a primary bank account holder with them. I think this is another really clever way of going down that path. By guaranteeing that kind of monthly deposit usage, it means you're much more likely to switch to them as your primary bank account, which I think is great. And I wouldn't be surprised if Revolut or others look at this and go, oh, we should have another tier that's a little bit lower, which actually we use this model because it's kind of easy to do, and we can put a few features in there and just lock it behind a monthly payment thing, because that's what all the banks want to do. They want to get you to fully switch to them and not to use them as that kind of secondary account. And this sounds to me like a great model of doing it.
Yeah, it's interesting because it's, you have to have at least $3,000 coming in every month, which isn't necessarily forcing you to put your salary into Chime and make it your primary account, but depending on how much you earn, maybe it is. So they also get that kind of monthly data on how much you're putting in your account, which you don't get in quite the same way if you're the quote unquote fun money account, if you're people's sort of secondary bank account. So Chime has 14.5 million customers, which is 12.8% of all new US checkings accounts in 2025 Q4 went to Chime. So they're making a decent play in the US space, particularly for that kind of neobanks. Sarah, what's your take on this in terms of them maybe trying to grow up a little bit, perhaps, in this space?
Yeah, I think what they're trying to do is attract far more affluent customers, because a lot of those accounts, if you look at the breakdown of who Chime's customers are, an awful lot of them are gig workers, is what we'd call, here in the UK, or they don't have a salary, they don't have an hour contract without regular hours in it, for example. And I think they have their MyPay product, isn't it, which is earned wage access or early access to your wages, right? That's not something that somebody on a regular salary generally needs. That's generally something that people who are struggling to make ends meet. So I think that gives away kind of a bit more insight into who their customer base is. And I did some digging for numbers, and I found some from Cornerstone Advisors, and it says that half of Chime customers earn less than $35,000 a year, and just 15% earn more than $75,000 a year. By contrast, half of Bank of America customers earn $75,000 a year or more. So I think what Chime is doing here is making a play for more affluent customers to whom they can sell a wider range of services, and therefore it's worth them taking a bit of a loss if that's what they're going to do on this kind of giving away a 5% interchange, a 5% cashback rate for no money in exchange. Because if you look at the way that, as Ollie said, that the UK banks do it, the Revoluts and Monzos, they make a killing on those paid accounts, because by the time you've got all the contracts signed up for Priority Pass or the insurance, you're basically, every pound you're making from that subscription fee, or 90% of it, is going into your pocket, because you've already signed those deals to distribute a product. So that paid model is proven, and if you look at either of those banks' annual results, you'll see just how much money they make and what percentage of their annual profit that is from their subscription accounts. Obviously, we just said this is going at it from a completely different angle. So my take on it is this is very much we want to be seen as more upmarket. We want more affluent customers. They're going to have more regular income, and we can sell them more products.
Absolutely. And Chaimae, would you agree with that? They've sort of launched this metal card, etc. It's feeling a little bit Amex in terms of the proposition, and obviously all the the perks and the loyalty that go with that. What's your take on this one?
I wouldn't compare it to the Amex, that's for sure. I get the sentiment, but I think, so I completely agree with Ollie and Sarah from what they've been describing. I get it that Chime was first catering to, I guess, a segment of the population that was kind of underbanked, and that's what their value proposition is to them. But that segment can also be quite risky for any company to put all their eggs in one basket. So it's very normal for them to kind of try to diversify, kind of tap on this a little bit wealthier portion of the population. Their launch of their new metal cards and all that, if they can do the right marketing around it, like Amex did. I mean, people get an Amex or a Chase Sapphire. It's mostly for the status, or sometimes for the very good marketing that these companies have made around these cards. It's not even about the card and what you can get out of it. It's mostly hey, I have an Amex. So if can Chime do that with their metal cards, then yeah, it's going to work really well for them.
And Ollie, you were kind of commenting earlier in terms of perks are earned through behavior rather than actually paid for, in terms of I've signed up to a subscription. As you were saying, that's sort of a differentiator. Do you think we'll see kind of more products behaving in that way rather than something you have to sign up to and get a subscription and pay X amount per month and so on? Do you think that could be a differentiator in this space?
Yeah, I mean, I think to Sarah's point there, they're clearly trying to change their customer mix and the behavior of some of their customers. And I think a lot of challenger banks around the world found this challenge, which is they grew very, very quickly early on, but they didn't end up with the kind of profitable customers that they actually want now. And they're asking, how do we change this mix? Some of them are doing it through switching, some of them are doing it through premium subscriptions. I think this is another avenue to go down. And as I said before, I would be amazed if we don't see other banks looking at this and saying, we want to make a change. Maybe $3,000 a month isn't our number. Maybe the number is different, but this is another lever we can pull to kind of incentivize a change in our customer base, to get us to that more profitable, more established destination we want to get to. So I'm sure we're going to see more of this.
Definitely, because they're spreading themselves quite wide now in terms of that that earned wage access, gig economy, and then sort of looking towards the more affluent. They're obviously spread betting on bringing in a lot of different kind of demographics in terms of what people are paid. Sarah, is there a risk?
And also, it's a model that we've seen in premium banking, in the kind of premium banking segment for a long time. We've seen the kind of like £150,000 or dollar deposits per annum needed for whether it's HSBC premium banking or whoever else. We've seen that for a long time, and it's an established kind of way of working. I think this is them doing it with a different demographic, with a different sort of strata in the lineup. Which that's the bit that I think I find really interesting.
Yeah, definitely, because I think whatever they were doing up until now has obviously worked. If they're getting a decent amount of the US new customers quarter on quarter, the customer acquisition is working for that kind of maybe lower income bracket. Is this, Sarah, do you think this is like quite a big swing to try and broaden their demographics? And do you think it'll work? As in, are the higher income brackets looking for this, or to sort of Chaimae's point, are they happy with their platinum Amex or whatever it is, the status symbols that indicate more just visually than what's going on behind them?
Yeah, I mean, I think it's so I think to the point about attracting customers, opening new accounts, that goes to Ollie's point. Are they using it as their primary account, or are they opening this for access to a specific benefit? There is a huge amount of conversation about Chime's issue with fraudulent account openings as well, and so I don't know if that figure takes that into account or not. There's been an awful lot of stuff in the news in the US, certainly, and not so much recently, but certainly historically, about kind of people opening accounts, shuffling money from one to the other, and then closing both those accounts, and the money never actually existed, for example. So I think the customer acquisition is one thing. How sticky are those customers? To Ollie's point, will this make them sticky? I don't know if this will make them sticky, and I don't know necessarily which demographic it's going for either. So I think to Chaimae's point, I don't think they're going for the people who have the Amex and the Chase Sapphires and the HSB premiums. They certainly want to move a step up from the gig workers. They want people with a regular salary who are going to get regular pay and kind of the equivalent of what we'd call direct debits in the UK. So kind of like having that regular outflow, which means you've got a regular inflow. It depends how sticky this will make customers and how much it makes them kind of use Chime as their primary bank. To me, will depend on how long they can keep up these perks. Because once you've given somebody something, it's very, very hard to take it away. So how long can they keep it up? How much money will it lose them? And if they do take it away, will they have offered enough benefits to customers to not then go, fine, we'll just go back to the bank account we were using previously? Because that's the other thing. People may open new bank accounts and switch, their primary account, but they very rarely close the old account. So there's always an option of keeping the one in the background to go back to. So it'd be really interesting to see if, I don't know who Chime's main competitor in the US is. They've got so many blinking banks, I wouldn't even want to start guessing. But if somebody's done that analysis, and because in the UK we get these figures every year of account switching, which come out centrally, and they're kind of completely neutral. So you can see who's doing best. And that's obviously, interesting for us data nerds, but it's obviously also interesting for the bank to see, oh my God, HSBC has lost X number of customers and Starling's gained X. That means logically that some of them will have switched around. So it'd be really interesting to see if there's any data out there for how many customers Chime gains versus how, what their equivalent or what their peer banks lose.
Absolutely. We will keep an eye out for that data and equally how this story progresses. But on that note, we're just going to take another quick pause. Back shortly.
LinkedIn Hiring Pro can't predict the future, but it can help you feel confident about future hires. Because Hiring Pro combines real-time insights and candidate data from the LinkedIn network with the criteria you've set for your role to deliver you a list of top-fit candidates. Businesses who use LinkedIn are 24% less likely to reopen a role in the next 12 months. Hire right the first time with LinkedIn Hiring Pro. Post a free job today at linkedin.com/quality.
Okay, now for a quick look at a story we don't have time to cover in full. This is Moniepoint enters the Kenyan market with acquisition of Sumac Microfinance Bank. This story in AFP. Nigerian powerhouse Moniepoint Inc. has officially entered the East African market, having acquired a 78% majority stake in Sumac Microfinance Bank. By acquiring an existing bank, Moniepoint gets immediate lending and deposit-taking powers in Kenya, bypassing years of regulatory paperwork. They are going after Kenya's 7.4 million MSME market. This sector drives 40% of Kenya's GDP. Expect them to deploy their all-in-one platform, combining banking, payments, and credit to replace the fragmented tools Kenyan businesses currently use. This builds on their recent acquisitions of Order Africa in the restaurant tech space and Bancom Europe for a UK-EU license. Moniepoint is now processing over $250 billion in annual transaction value. And on this particular acquisition, this is a very savvy ploy for Moniepoint to help them enter the third or fourth, arguably biggest fintech market in Africa, their home market, Nigeria, being the biggest. Kenya is obviously well known for its smartphone penetration and reliance on telcos to support financial inclusion and financial services progress generally. However, it does mean that the landscape for SMEs and MSMEs is particularly disjointed. So Moniepoint are making a big statement entering this market through that acquisition with Sumac Bank with a more seamless offering that immediately solves for a lot of pain points that merchants and MSMEs face and offering them more tools and opportunities to boot. And it also says a lot for Moniepoint's international ambitions, and it will be interesting to see how much traction they get as a result. And we will certainly be keeping an eye on it. And now I'm going to move us on to our final section, and finally for today. Plex's $500,000 survival retreat goes full Fyre Fest. So this story has been picked up everywhere and is doing the rounds, but it features tech company Plex spent $500,000 to fly 120 remote employees to Honduras for a survivor-themed bonding retreat. And the goal was team building and light competition, but the reality was a medical and logistical disaster that makes the White Lotus look like a spa day. CEO Keith Valerie planned to act as a host-like figure, similar to Survivor's Jeff Probst, I'm not actually sure how to say his name, but spent the entire week instead in his room on an IV drip after eating a bad salad, which is not a great start, but it gets worse. The first challenge involved lifting a lid and eating what was underneath, and one exec said that they had to eat a dead tarantula. Not good. At least it was dead, I suppose. But anyway, they hired a Navy SEAL to run drills in 100-degree heat with employees who had to army crawl through fire anthills until they passed out from exhaustion. This retreat also featured guard towers with machine guns, failing electricity, and no running water. And to top it off, a porcupine fell through the ceiling of a senior engineer's bedroom in the middle of the night. And most tragically, CEO Keith Valerie could then literally hear his employees screaming from his sickbed. Okay, so there's a lot to unpack in this. I'm sure all of us have been on sort of off-sites and sort of organised fun that we don't necessarily want to be on, but I can't say I've been on anything as bad as this. But Ollie, what was your take on this? Normally, kind of company off-sites don't come close to this horror show.
No, I love the effort that has gone in, like not just the financial effort, but clearly someone has spent a lot of time. I mean, I suspect the CEO was maybe a fan of Survivor, but a lot of effort has gone into this. I did read the article and saw that it was actually in 2017, so it was a few years ago. Again, when rates were a bit lower and maybe cash was a bit easier to burn on things like this. But yeah, this definitely tops the cake for
I mean,
for
there's
corporate
burning
culture.
cash, right? And then there's
Yeah.
just torturing your staff, right? I mean, Sarah, have you never been so glad to be freelance and independent when you read this one?
Yeah, I mean, I tell you, I've endured some horrendous team building activities in my time, but none of them involved tarantulas or machine guns. Part of my question is, now my geography is terrible, so please nobody take offence to this. Why Honduras? Because I've just looked up the UK government website, which is for foreign travel advice, and it just says no travel can be guaranteed safe to Honduras. So why that as a location is a question I have. Now maybe there's bits of Honduras, I don't know. I mean, as you say, if Ollie's right, this is 10 years ago, so maybe it's the height of bro culture and like torturing your staff proved you were like a chief bro. I'm struggling to get my head around the idea of why anybody thought this was a good idea, aside from the food poisoning and the 100-degree heat and the showers not working in the resort. Like before all of that, who thinks, you know what I'll do? To your point, Laura, I'll torture my staff, like literally, physically.
Yeah.
Secondly, if these are US employees, is that company still going, or have they been sued into non-existence?
They are still going. It's a media streaming server tool, which I'm a fan of. I had no idea that they did stuff like this on their away days. But
oh, is it like a Roku stick? Is that yes?
Yeah,
okay,
it's a bit like that.
Just
It's a bit like that. But yeah, why Honduras?
Yeah.
I wonder if that's the only place they could get away with a lot of this this stuff.
I think the why is the most pertinent question to this. I think. I mean, like, how does eating tarantulas and doing kind of, what was it, sort of Navy SEAL training actually help you get better at your job, particularly if your job is sort of software engineering and so on. Software engineering versus sort of intense sort of Navy SEAL training don't often go hand in hand. The why is the bit that fascinates me most. Chaimae, what was your thoughts on this?
I mean, it's just a big parody of what we think of being loyal to the company and hustle culture and just really taking everything. It's just a physical personification of what you think like a lot of people in different like very high pressure jobs and high pressure companies are going through. I mean, obviously not the tarantulas and the machine guns and not like no running water, but I think it is just hilarious that some CEO took that hustle culture really literally and wanted his, I guess, employees to go through it to show, I guess, their loyalty to the company or something like that. That's definitely changing. If I can speak for all the Gen Z listeners out there, is like there's no such thing as that level of loyalty to any company, especially when you can sue them, as Sarah said, out of oblivion. So, yeah.
Yeah, we'd love to know if it was optional attendance to this thing,
I point blank refuse to do sports days when I've been at organisations. I won't even play rounders, so there's no way I would have committed to this.
Although there was a rounders game that got out of hand at 11FS where like someone accidentally hit a passerby, so probably, you were right to sit that one out.
I wasn't involved before the rumours start.
Yeah, Ollie, best or worst organised fun you've been part of? Did it involve tarantulas?
Oh, it did not involve tarantulas or heat stroke or any of those other horrible things. Good. Give me good Wi-Fi and a nice hotel and a couple of meeting rooms, and I'm happy. None of this. My only thing is, I wonder if they told the staff what they were getting into, because I think if the company said ticket to Honduras for the team building offsite, you'd be like, yeah, that sounds okay. If they skip the detail, like gloss over the detail a little bit until you get there. That I think that's how they sold it.
Yeah, I think you're completely right. Come to Honduras for a week, it'll be fun. And then they just didn't tell them anything else. I think that's so true. And I'm going to wrap the show there. Thank you so much to all of you for joining me today. Where can people find out a little bit more about you, your companies, and what you've got going on? Maybe start with you, Ollie, for all things Money 2020.
Yeah, you can find me on LinkedIn, Oliver Smith, or find money2020.com. Come and have a look at the Europe page, have a look at our agenda, which went live today, all of our speakers, all of our sessions, and hopefully see lots of you in Amsterdam this June.
Fantastic. Thank you. Sarah?
You can find me on LinkedIn at Sarah Kocianski, or you can find me in Amsterdam at Money 2020 in June.
Fantastic. And Chaimae?
You can also find me on LinkedIn, or you can read me at thelogic.co. We have an app that you can download available everywhere, or you can read us online through our website, thelogic.co. And yeah, we have a bunch of newsletters. And if you're interested in Canada and Canada-US relations, we've got you covered.
Fantastic. Thank you. And you can find me, Laura Watkins, on LinkedIn or 11fs.com or this very podcast. And so that wraps up today's episode. Thank you so much for listening to today's show. If you like what you've heard, please make sure to follow us on your favorite podcast platform of choice. And if you really like it, please do feel free to share it around, share it with a colleague or friend. And if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider on basically any platform and we'll probably pop up. Or email podcasts@11fs.com. Thanks again and goodbye.
¿Hablas español?
Sprichst du Deutsch?
Kan du norsk?
If you used Babbel, you would. Babbel's conversation-based techniques teaches you useful words and phrases to get you speaking quickly about the things you actually talk about in the real world, with lessons handcrafted by over 200 language experts and voiced by real native speakers. Babbel is like having a private tutor in your pocket. Start speaking with Babbel today. Get up to 55% off your Babbel subscription right now at babbel.com/Spotify, spelled BABBEL.com/Spotify. Rules and restrictions may apply.
Two kinds of phishing out here. One for fish, one for your data. Hackers try to hook you, but Cisco Duo keeps every user and device protected. Cisco Duo. Phishing season is over. Learn more at duo.com.
Hey, business owners. The NFL season is a big revenue driver. Now there's a smarter way to get ready. EverPass is the only authorized commercial platform for NFL Sunday Ticket, delivering every live out-of-market regular season Sunday afternoon game. Lock in the best offer now with up to 40% off, saving up to $2,500. For the first time, you can pay over 9 months. Get up to 6 free devices and a free bar kit. Sign up by April 27th. Visit everpass.com. Limited time offer. Terms apply.